Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of New York and London sugar markets. However, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production or recognition of any of the patterns, levels, analysis or any related items on these my charts. This was all authentic intelligence, all my own original work, as I think you deserve to have that. So with that, ice raw sugar in New York. The main pattern here since September 2024, so coming up to now a year and a half, has been, though I'm now looking at another pattern to lead the market lower, but in the meantime it has been, despite being breached and repaired, the dark blue September to December 2024 bear channel, which is currently 847 to 1364, which developed into an descending expanding wedge pattern. We're at this time once again just over the top of the dark blue upper trend line. For most of January and February we have been resting on top of this dark blue upper trend line, though not really pushing up away from it. Last week saw prices rise up and get capped by the combination of the declining green short medium moving average and the medium moving averages at 1461 and 1475 respectively, as well as the March 21 low at 1466. The peak was with a key reversal down, a daily key reversal down last Thursday, and we are now once again heading down to mix it with some of the congestion between, as I said 16 weeks ago, and I quote, "We now have support on the downside on congestion based around the significant 61.8% absolute Fibonacci line for the 21st century at 1383, which stretches from 1409 down to 1379, end of quote. Last week's move higher had also been capped by the base of the old rectangle pattern from between mid-November last year to early February this year. Then there is the other main pattern, the one that may be taking over from the dark blue bear channel stroke descending wedge pattern. It is the bright green late September 24 to late February 25 bearish shift pitchfork. We are today resting on the bright green middle time below, or just around actually I should say, and that's currently at 1396. That is mixed in with the congestion that I spoke about below. Looking further down the market, well, we have some support at congestion dating from the early to 2020s in the 1248 area zone, and a gap between 1336 down to 1320 dating from September 2020. So a lot depends on that congestion support between 1379 to 1409. Now, there is a larger third pattern at work here, and possibly the more important one, though you wouldn't have guessed it from its behavior in October and November last year. It is a larger bearish pattern and a good contender even now in showing the bearish angle of attack. It is the longer term bright red November 23 to September 24, similar but slightly shallower bearish shift pitchfork. On this one we're a little above the bright red middle time, which is currently at 1328. Finally, going back to the previously mentioned rectangle pattern between mid-November 25 to early February 26, by the numbers between about 1440 to 1535. 4 weeks ago I said on this, and I quote, "We are below this right now, but in the congestion below holds, and if the congestion below holds and we see prices raise back up, then the pattern will have repaired itself. If it doesn't, then we'll have to start looking at potentials below of a primary potential in the 1389 zone and the secondary hard reach potential down in the 1345 zone, just above that previously mentioned gap," end of quote. Since that time we have developed the move lower from the rectangle pattern, reaching the primary target 2 weeks ago, but failing so far to extend down to the secondary target X. I had thought last week that given what's happened since, the primary target may have been enough, and I was minded to retire target X by today, but on second thoughts, now no. Let's see if prices can try once more down to target X. Ice Europe white sugar in London. After all this time, there still continues to be Three features to this market to keep bearing in mind on my daily chart. The first of the three features is the obvious: broken, repaired, broken again, repaired, and lately broken, repaired, twisted and bent out of shape. Bent out of shape purple late September 24 to mid-February 25 descending expanding wedge pattern. Currently 396.22, way off the bottom of my daily chart. This pattern had more than requisite 5+ touches necessary back in January 2025 and had since then been severely tested on the top side, enough that I would not classify it as a descending wedge pattern after February 2025, though I continue to still keep an eye on the extension to the purple upper trend line. As it is, bar some congestion above at 425.5 and below the November 25 low at 406.40, the nearest support stroke resistance to this market. Next, I also asked you 44 weeks ago, so coming up to a year now, to, and I quote, also keep an eye on the bright pink late September 24 to mid-March 25 recently finessed bearish shift pitchfork. This is a very shallow pitchfork, and the more the market moves lower through it, the more I'm beginning to like it. End of quote. Well, since then, the market initially started utilizing the bright pink middle sign of this bearish shift pitchfork, it's currently at 436 even, as an attractor, riding prices lower in a shallow glide until early October last year, when it commenced a steeper journey lower, such that in early November last year and again in mid-February this year, the market had been closer or was been testing the pink lower time, which is currently at 377.60. The 4 or 5 weeks ago accelerated into a pipe bottom late 3 weeks ago and then into a V bottom, with last week and this week so far being the shelf to the V bottom. It really was good to see how the lower pink tine, along with the congestion at 378.20 dating from 2020, halted the fall and turned prices back up again. Indeed, the last 2 weeks shelf construction is now a possible bullish halfway hesitation or bull flag for primary target at 420 even, which has already been achieved, and a secondary harder to reach target X up in the 438.60 area. There's also a third more recent feature, and this one had been true for New York Sugar as well as into London. There's a formation of a rectangle pattern over recent months, roughly here between 415 even to just over 435. 4 weeks ago, prices broke well below this pattern and reached the primary and secondary targets before making that pipe come V bottom pattern. Today, prices have risen back up into that old congestion between 415 even to 435 even, pushing up over the green short medium moving average, which is currently at 415.70, though not stabilizing over it, because it halted at the mauve medium moving average, currently at 420.5. Now the next congestion above is at the previously mentioned 425.5 area, which seems right now a little hard to reach. I should just remind you my words of last week when I said, and I quote, please bear that in mind, as the top of any bullish halfway hesitation come bull flag is the top of the congestion area. End of quote. Sugar white premium spread. I think I have to set aside my previous thoughts on this spread of a diamond top pattern, then of a possible head and shoulders top pattern, then of a bearish halfway hesitation pattern, as one new feature, has to be fair, erupted on this market that now trumps all these bearish patterns. Well, to my mind at the moment trumps it, and will likely after this week cause me to retire targets X down at 70 even and target X1 down at 43 3/4. I said as much last week when I said, and I quote, with the gapping action higher seen specifically over the bright red neckline, I am on the verge of retiring these targets below. It's only that prices have closed last week on the mauve medium moving average, currently 99.25, and the high has not exceeded the gold long moving average, currently 107.5, that has stayed my hand in taking them down this week. What the market does with these two moving averages in the next few weeks will, I believe, determine the future. End of quote. Now, I went on further when I said 20 weeks ago, and I quote, only concerted, consistent and long-term moves over the new bright red neckline and ideally over the slowly rising long moving average could possibly assuage the bearish potential, at least as far down as the 70 to 85 congestion. End of quote. Now, we had in recent times been half there and half not there, and the moves over the last 15 weeks exemplified these half in, half out courses of actions. It had looked like indecision, but on a much, much larger scale, more than just a weekly chart can really show. But the single new feature that has shown up in the last week has tipped the balance for me, and that was a monthly key reversal up seen here in February. This week prices are already over the mauve medium moving average and are challenging the gold long moving average. And all this has been enough for me to retire targets X and X1 after this commentary. Thank you for watching and listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.